Big cap tech doing pretty well this morning. We've talked to banks, we've talked to inflation response on the macro basis. Time to look at the giants. Joining us, Matt Tuttle and Mr. Tom White, host of Fast Market here with me in the studio, and Matt's the CEO and CIO at Tuttle Capital Management. Matt, what are you seeing this morning? People feeling good, buying up your levered funds, or what's the response to inflation?
Yeah, I mean, people are feeling good buying up our levered funds. I think, the market got oversold a little bit. Really right now it's all about rates. And rates went too far too fast. You had a little bit of cooler, inflation numbers, some cooler economic numbers. Personally, I'd probably look to fade this. But, we'll see. I'm keeping an eye on rates right now.
What's the best way to fade the market using your funds right now is in your suite of products? Would it be doing like an inverse to like a high beta name or something?
Well, yeah, I mean, we've got, NVDQ, which is inverse Nvidia. I don't think I'd be doing inverse Nvidia. I mean, they sold off, after that conference last week. I think that's overdone. Tesla Z is inverse Tesla. MSTZ is inverse MicroStrategy. That's probably where I'd go. MicroStrategy's been up big a couple days in a row. So I may look to fade that.
Interesting. Okay, I like that. Love the thoughts. Looking at the calendar, how do you think inflation compares as a force to Trump 2.0 right now? Does this give us clearance to start speculating again about what good things we might get? Or do we still have to deal with prices over this year? Is that going to still hover over us with inflation shy of 3%?
Yeah, I mean, I think we got two things here. We've got obviously a lot of optimism over Trump coming in and in some of the sectors that are going to benefit. But then number two, you've got a Fed that's woefully behind the curve. Bond traders have been telling them that for a while. And now we really are back to having no clue what the Fed is going to do this year, if they're going to do anything. So certainly that is going to be an overhang unless we start seeing a slew of numbers that come out and can give us some real certainty over what they're going to do, and hopefully some certainty that they have a clue, which I don't think we're going to get, unfortunately.
Okay. Hey, something I know you've been watching, which is the market impact of the wildfires, to kind of go for a tangent for a second, but you've always got an interesting take on things, and I'm curious what you think about that and if that's going to have a meaningful impact on any of this.
Yeah, I mean, I think it will on certain stocks. This is going to be a multi-billion-dollar cleanup effort. So they're going to be winners and they're going to be losers. So, we bought a couple days ago, a couple of the names we thought would be winners. There's T-Tech, there's ACOM, a couple of the home builders, KBH and Toll. And we shorted some of the insurance companies, specifically MCY, that, we think could be the losers. And, in a market that currently there isn't a lot interesting, that's a fun place to go, I think.
Yeah, fair enough. All right. Always like the ideas. Thanks, Matt. Appreciate your thoughts.
All right. Thanks.
You got it. Matt Tuttle, CEO, CIO at Tuttle Capital Management. All right, Tom, let's look at some tech trades here. I like Matt's thoughts on maybe the levered approach through funds. Always interesting to kind of hear where he thinks you might want to express a fade. You're looking at Nvidia and you're looking at Apple. Let's talk Nvidia first, because I do think, to Matt's point, Nvidia did get hit pretty hard since the CES thing. It's down near the low end of the range. It seems if you think the market's going on a big run, maybe not a bad time to think about re-entry into Nvidia.
Yeah, correction territory, down, about 13% from its recent all-time highs that we saw on that CES day. Remember that, about $153. But implied volatility levels really low in there, even though we've seen the stock slide. The IV percentile rank is about 6%. So in the lower 95th percentile of what we've seen implied volatility levels over the past 52 weeks. So that gives you some opportunities maybe for directionally biased trades based on your assumptions because they're going to cost a little bit less, right? Because implied volatility levels are low. So I went out to the February monthly cycle that expires on the 21st here as an example. They report earnings the week following this expiration. So if you expect the stock to maybe consolidate and start to rebound from these levels, this takes advantage of it over the next 37 days. Going out to that February monthly cycle that expires on the 21st, buy the 133 strike call. That's basically at the money. And then against it, because I want to offset some of my costs on that bullish call buy, sell the 143 strike call. So buying a $10 wide bullish call vertical to the upside, you're paying roughly about a $3.80 debit for it. So there's your risk. That can expand to $10 if this stock goes back above 143 at expiration. And by buying this vertical, it gives you some flexibility as far as trade management goes. Say you get a pop in the stock, it goes up to 140, this thing doubles in value or expands in value. It gives you the opportunity to close it prior to expiration if you want all or a portion of your position. But this is a bullish way to take advantage of that low implied volatility while offsetting some of your costs by selling that 143 call against the long 133 call.
All right. I like that approach. So you also sell the 143 so that you're covered and you get a nice participation to the upside, kind of back through to that 140, which has been the battleground for Nvidia, basically the center of its oscillation since October. So I don't know, it might be a little bit of a tough road though, because Nvidia's been chopping around all morning, and it dipped pretty hard at the open. It came back. Now it's kind of slowing down a little bit again.
It seems like they're selling every rally in there for some reason over the last week and a half.
That's why I'm watching that real close here. But the NASDAQ just did put in a new high for the morning a moment ago, so we're trying to pump it up a little bit in big tech. Russell's been easing off a little bit, so it really is seemingly coming down to some of the tech stuff here. Okay, you got to trade in Apple. How about that? Up about $4 today. Apple's getting a nice move.
Well, if you've been wanting to short this due to valuation, today's a good day to do that. But I've got something a little bit more bullish, but I'm offsetting some costs. It's not like a big blowout bullish trade to the upside. You're containing your risk on this type of position. But I looked at a skewed or broken wing call butterfly to the upside. Going out to the January 24th weekly cycle, they report earnings the following week. So I want to avoid that event because I'd be careful with Apple going into earnings with valuations this high. They better bring out some good numbers and good guidance. But this takes advantage of a move maybe up into earnings where you can take advantage of some upside. Looked at that skewed call butterfly where I'm going to buy in the January 24th weekly cycle that expires in 9 days. Buy one of the 235 calls, sell two of the 242.5 strike calls. That's where you want it to go. And then to wrap it up, to make it risk-defying, buy one of the 245 strike calls. So in essence, you're buying a $7.50 wide bullish call vertical within this strategy, and then offsetting some of the costs by selling the $2.50 wide one. You're paying roughly about a $250 debit. It might be up to $280, $290 at this point. Stock has continued to move higher. But if you pay a $250 debit, there's your risk. Your break-even goes up to $237.50. Over the next 9 days. That's less than 0.5% above the current share price. You're almost to that break even now. But this is a controlled bullish type of trade where even if it consolidates here a little bit, just moves a little bit higher, you're going to profit. You want it to go towards that short strike. But even above 245, it's going to be a profitable trade.
Okay. So you've got several outcomes that work for you. You want a little bullish buy.
Yeah, it's not like expecting the stock to go back to those all-time highs.
It's not
but if
either.
It does grind higher into earnings, you avoid that earnings event. I think that's a setup I kind of want to play here at Apple because I think there's plenty of downside risk post that earnings.
Okay. Good trades. Generally bullish with a little caution in it. Nvidia up $1.70 right now. Apple up about $4. Big tech looking good.